Okay, well, so much for summer doldrums. Right now we are watching a market that is on the move and having to react to headlines around what's happening in the presidential race, having to react to what happens with interest rates, a story we'll be watching very closely this week in Canada. And certainly when you've got such a strong sector performance-wise like tech this year, you can't ignore what's going to happen with tech earnings, and we've got a few key players reporting this week. Brian Belski, Chief Investment Strategist at BMO Capital Markets, joining us here in studio to... He's busy. You're busy.
Can we breathe here a little bit? I mean, is there anything going on in the world the last 8 or 9 days?
Does it feel like a less than normal summer stretch for you?
Well, first off, good morning, Canada. Yeah. I've been trying to think a lot about, perspective in this. And I remember back in August 2007, I was the head of U.S. strategy, sector strategy at Merrill Lynch. And I remember we got a memo from the director of research at Merrill saying, may want to cancel or postpone your vacation in August. And that was just the start. I mean, that was way before. Essentially August of 2007 is when the Fed opened the window and essentially started QE, but that really started the unwind of what happened in financials. But this notion of summer doldrums, we've seen the last few years. I mean, think about the last couple of years. In fact, I remember, you and I off air were talking about vacation. I remember 2 years ago, I was in Portugal and the market was the market was rallying in July, August. And then the second half of August, the market really started to unwind and people are like, Belski, what's going on? And I remember being on vacation, writing a note on my phone about markets because people were you used the term before we even started this hit, reacting.
Yeah.
So I think we just need to kind of take a step back and look at the fundamental conditions of both stocks in Canada, or both the United States and Canada, and say, okay, we're in a pretty good spot.
Good spot. I guess the fact that we have had record highs, and I'll use the S&P 500 just for the point of conversation here.
Right.
It's had a nice run. And I think that for some people, that's exciting. Don't fight the tape. Others, I think, though, with all these other factors out there, are trying to figure out, especially with not a lot of meaningful pullbacks so far, Brian, I guess people start to wonder if, that's going to make for, a busy August,
right.
so to speak.
So we've long said, in fact, in print since November of 2023, when we put out our forecast for 2024, saying the average correction during the second year of a cyclical bull market. We think the cyclical bull started in October of 2022, thus this is the second year. You see the average drawdown since 1949 of 9.4%. Lots of numbers, Brian, blah, blah, blah. But let's throw some numbers of what's happened so far this year. We've had a 5.5% drawdown in that March-April timeframe. And we do have a lot of bullishness and we have a lot of agreement on the strategist community and the analyst community. Typically and historically, from someone that's been doing this for a while, when sentiment becomes that positive, we're going to have a pullback. And now, given volatility in politics, volatility geopolitically, our earnings priced to perfection, have people miss the move in markets? Are they waiting for pullback? Are they fully invested? All these kind of questions, I think, really point toward a correction happening sooner than later, which, oh, by the way, would be very normal and part of the normalization process that we haven't seen in markets for a while.
This is an important point, I would think, because you have been one of the more consistently, call it bullish, strategists on Wall Street. We've been talking a lot about, because the market has steadily been rising, a lot of strategists have had to update their views on the market. We had a conversation last week around, if they're going to update again their forecast, what's going to be the reason this time? You were saying, don't be surprised if there's a correction.
Don't be surprised if there's a correction. It's really interesting, too, people that have kind of marked to market, quote unquote, their forecasts, and then all of a sudden now they're saying, we need a 10% correction, too. So which one do you have it? You can't have it both ways. And I think it's part of the, I would say, growing short-termism of investors and strategists in particular that was really accentuated during COVID, kind of started during the second wave was really kind of during the great financial crisis of 08-09, but really started post the tech wreck, where we became too reactionary. We were so afraid to be wrong. We didn't want to be right, and so model driven and so quantitative that kind of forgotten to look at the forest through the trees. And so many people, John, want to make the big market call where they forget that the stock market is a market of stocks. And so that's why we think underneath, we take a look at all of our measures in terms of our process. We think it's a stock picker's market. We think Canada's well positioned. We think value and cyclical is well positioned. And we think that you need to own a little bit of everything.
So let's go into some stock examples right now. So if we're talking about a market like Canada, for example,
Right.
is there anything that really stands out to you as something that might be steady Eddie, a good bet at a time like this?
Well, Steady Eddie, I think, one of the things that I think people are missing, that we have these great energy companies here in Canada. We're so worried about what's going to happen on the political front. You have a company like Enbridge, where it's the cornerstone of a Canadian investor and how they look at stocks in terms of dividend growth. This is a stock that has almost 12% free cash flow yield and well above its dividend yield. You want to start and stop with that when you're looking at a company that's paying a dividend. If they continue to be able to facilitate the dividend over time, plus if we are going to move into more of a Republican type of situation in the United States, that's good for the energy companies and also be good for pipelines and good for all of that. But Enbridge has been a name that we've owned for 12 years in our various portfolios at BMO, and one that we continue to own.
And just to give an example of an American stock, I know, and you mentioned the election, I mean, there's a general view in the banking sector that if Trump were to emerge victorious, that wouldn't be the worst thing for the larger financial institutions. But how do you think about the financials? Because we're watching them in Canada as well.
Well, you have to kind of think about the fears of when Mr. Biden took the presidency was regulation, 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 right?
Yeah.
And tax, tax, tax. Now now talking about Trump deregulating, but there was already talk about Basel III being less regulation. There's all been in talk the last 12 months about less and less regulation. Our theme for financials has been resolute with respect to buy scalable businesses, meaning the really big banks and the broker dealers and asset managers, but don't forget the really, really, really small banks that have, and their businesses are driven through relationships. So that puts kind of the middle area, the regionals in our view. They have some issues, and I think that what's going to end up happening, because they lack scale, they're going to need to see some M&A activity. You're going to see consolidation within the regionals. Now, we don't buy stocks because they're going to consolidate. We buy stocks because they're fundamentally sound. So I think you're going to see a wave of consolidation over the next couple of years within the big super regionals in the U.S.
And real quick, Citigroup, sort of as a larger bank, which has been going through a turnaround of sorts, a transition.
Yeah, Citigroup was to 2023 what I think TD is to 2024 in Canada. So Citigroup in 2023 was a stock that was under much turmoil, cutting divisions, cutting people, new overall leadership the last few years. And I think Citigroup is still very, very well positioned longer term, and still is an area, by the way, that is still more value oriented. And a lot of the growth investors don't own Citigroup. They'd rather own JP Morgan.